So go ahead and get started here. Again, the Q&A is up here, up at the top of your screen for some of you, and then at the bottom for others. So let's go ahead and get started. Just want to do a quick disclaimer. This presentation is for informational purposes only. It does not constitute an offer or sell solicitation to buy any type of security. Please be aware the presentation and does not and cannot replace the PPM. PPM is the document that you must read to invest in our mortgage fund. Also, I am not a CPA, an attorney, or legal accounting advice that we provide today. I recommend talking to your CPA or financial advisor. This is just a cursory overview of some of the tax advantages that we offer in TaliMar Income Fund 1 or using a REIT structure. So today I'm going to go over a little about myself. We're going to start talking a little about TaliMar Financial. We're going to then go into what is a real estate investment trust. We'll talk about how a mortgage REIT is structured, or a mortgage fund is structured as a REIT. We'll discuss some of the important terms that you'll want to know, such as qualified business income tax deduction, or QBIT. We'll also talk about, for those self-directed IRA investors, what unrelated business taxable income is. And then some other tax considerations. So if you're investing out of state, what the tax considerations you should consider when investing in a mortgage fund, where are they lending, and what that means to you. And then briefly go over for foreign investors. I don't think we have very many foreign investors on this webinar, but there are some tax advantages of a REIT for foreign investors. And then we'll go over our fund and talk about some of the parameters of those funds. As I had mentioned, you can go ahead and answer or ask questions throughout the webinar, or you can leave those questions till the end. I'd be more than happy to cover them at the end of the webinar. So a little about my background. I am a graduate of the University of Michigan. I've also done additional coursework at UCSD in real estate finance and accounting. I started my real estate career in 2001 with QBIT, with their private equity group. I was a financial analyst running the cash flows and numbers for what we call mezzanine debt transactions, also known as joint venture equity transactions. What we would do would be to partner or lend to residential developers throughout the West Coast, provide them the financing they needed to complete their projects. Had a great opportunity, great run up and through about 2008 when there was a slowdown in the housing market. And from there, stepped over to working with the Federal Deposit Insurance Corporation, FDIC, for 2 years. I was part of the team that would go to banks and effectively shut them down, underwrite their loan portfolio, and then sell off that loan portfolio to private investors. It was a great opportunity, had the opportunity to kind of look behind the scenes of some of these failing banks, find out why they failed, what types of loans they were doing that put them in that position. And then I established what is known really today as TaliMar Financial in 2008. I went out and started lending money to investors that were buying houses either at the foreclosure steps or buying them directly from banks. Didn't even realize there was an industry behind what we do today. And then I really kind of took it full time after I left the FDIC, took it full time around 2010, continuing to lend my money out. And then I opened it up to outside investors. Effectively, what we call it today is trusted investing. So I allow opportunities for investors to invest in the loans that I originated. And then in 2021, I established TaliMar Income Fund 1. By late 2020, we were managing a little over 50 million in individual trustee investments. It became just too unwieldy to manage that many investors in that many loans. So we decided that a much more efficient platform to invest out of was to create a mortgage fund. The idea was to transition a lot of our investors from that trustee model, which we felt was a much better investment to invest in the mortgage fund, It allowed investors to be much more diversified in the trust deeds they were investing in, allowed us to transact much quicker, make choices much quicker on the loans that we were funding. And it also created a more consistent approach for our investors to, again, to invest in trust deeds. I do hold a California mortgage broker's license, and I am a certified fund manager through the American Association of Private Lenders. Currently live in San Diego with my wife and 3 beautiful children, and I play competitive tennis. In fact, I did win the club doubles championship last week, so that was a good win. As I mentioned, I'm a certified fund manager through the American Association of Private Lenders. A lot of you are probably asking, Brock, why are you putting a lot of these webinars about the REIT and the mortgage fund? That's because I continue to do coursework on fund management. In fact, last week, I did attend the American Association of Private Lenders event and spent an entire day listening to Kevin Kim with Gerasi on essentially certified fund manager 2.0 information, which again, it goes into much deeper dive into general fund management, especially using a REIT structure, which is what we're going to talk about today. A little about TaliMar Financial. As I mentioned, we established TaliMar in 2008. We're located in San Diego with 5 employees in the US, with other employees outside of the US. We funded a little over 850 loans, totaling over 325 million. Currently service 92 loans in our portfolio with an outstanding balance of 51.9 million. We established TaliMar Income Fund 1 in 2000 or early last year. And the fund right now consists of 40 loans totaling over 23 million. We have a weighted average coupon of our loan portfolio, which is primarily the underlying assets, what we're lending on, are primarily located in the San Diego market and then just general Southern California market. So we've seen a significant rise in the average coupon as rates have risen over the last 6 months. That has had a positive effect on the returns of the portfolio. And we have received the highest designation of verified gold by Verivest. Verivest is our fund administrator. They did a full audit of TaliMar Financial, including our history of loans. And through that audit, we earned the highest designation of verified gold. So let's go ahead and get started with kind of the meat of what we're going to talk about today. Again, it's going to be a real deep dive, so feel free to answer any or ask any questions, and I'll try to get to them throughout this webinar. So let's start off with what is a REIT? Well, a REIT is really kind of a simple structure, and what it is a company that owns, operates, and finances income-producing properties. Now, it's important that we understand income-producing. It's really supposed to be a passive investment vehicle for investors. The actual REIT, the structure, was established back in 1960. And the idea here was to allow individual shareholders like me and you to invest in a portfolio of commercial real estate. Prior to that, you would have to have a complicated structure that was only really available to large institutions or very high net worth investors, where they could invest in a portfolio of commercial real estate. The REIT structure, and very similar to kind of the mortgage fund structure that we've created, again, allowed investors to become shareholders right here. So you've got your shareholders of the REIT. All right. And then those shareholders would earn actual distributions from the income generated by the assets owned by the REIT. Now, generally, the idea was that it was going to own a large portfolio of commercial real estate, and you investing in the REIT could own a diversified portfolio of commercial real estate. But what they also allowed for is to allow the REITs to invest in mortgages, which is what we do. We invest in mortgages. Or you can have what we call a hybrid REIT. So a hybrid REIT is both commercial assets, which not just include commercial real estate, but also residential real estate, industrial. There's all types of REITs now that own all types of property types or mortgages. or a hybrid, again, a hybrid REIT, which is kind of combination of both. So again, the income generated from those assets flow through the REIT and then out the REIT as distributions, dividends to their shareholders. Now, it's become actually a very popular model. In fact, over 40 countries have adopted this similar type model. And it's a massive industry. As I'll talk about earlier, it's over $3 billion worth of real estate is owned in a REIT type structure. So it's big. So an interesting statistic here, REITs own, as I mentioned, over $3 trillion in real estate assets, and that's according to REIT.com. Today, approximately 145 million Americans live in properties owned or financed by REIT stocks, mutual funds, ETFs, or target date funds. So it's big. And there's a lot of real estate owned in REITs. NAREIT, which is the National Association of Real Estate Investment Trust, kind of serves as the worldwide representative voice, according to them, for REITs. So they've got a great website. If you get a minute, just go to REIT.com, and they've got some really good articles on statistics. They compare different REITs. There's a lot of information at that website. So I would highly suggest, if you get a moment, to go ahead and go to that website. All right, so what are qualifications to be a REIT? Now, it's really important. When they created the idea of the REIT back in the 1960s, they did put some pretty heavy restrictions on what a REIT can do because it provided such great tax advantages. But what they were trying to do was to get more investment dollars into the real estate industry. So some of the restrictions on a REIT, or the requirements, is that at least 75% of the total assets have to be held in real estate cash or U.S. Treasuries. So the idea is that you can't go out and buy a business in most cases. Now, you can structure REITs that you can do that with, but the intention is that you actually physically hold a cash flowing passive investment, such as commercial real estate or mortgage funds. It has to derive at least 75% of gross income from rents, interest, or sales. Now, again, the idea is it's a passive income. And so what happens is that REIT invests in, again, a commercial real estate asset. That income is a passive income that flows into the REIT, and then that REIT gets paid out as dividends to the investors, which kind of flows into the next bullet point, which is 90% of the taxable income has to be paid out in dividends. So all that income that's generated by the REIT, 90% of that has to get paid out to all the shareholders of the REIT. If it doesn't, there's some tax consequences with that. Entity is taxable as a corporation, so the REIT has to be structured as a corporation, and it requires 100 shareholders with no fewer than 5 shareholders owning more than 50% of the company. What they're trying to do is not get one or very few very high net worth investors into a single REIT. And it's kind of an interesting structure that you have to do in order to create a mortgage REIT. We'll get into this on the next slide. So the question goes, okay, Brock, so how is a mortgage REIT structured? Okay, so it's actually simple, and it allows us to get the tax advantages of a REIT, but still manage it as a mortgage fund. So layer one, you've got the investors. Now, you may call those are going to be members of the LLC or the mortgage fund. So when you sign a subscription agreement into the fund, this is technically what you are investing in. You are an owner in the mortgage fund. That mortgage fund then becomes a shareholder of the REIT. So you're one shareholder of the REIT. And then it's actually the REIT that physically funds the loans. So the underlying assets owned by the REIT are the deeds of trust that the REIT secures against the properties that it's lending against. Now, if you remember earlier, we talked about, well, you need 100 investors in a REIT. And this is where it gets interesting. There are companies out there called shareholder accommodators. So because the mortgage fund is the only technical shareholder of a REIT, you need 99 or 100 other shareholders, and there's actually called penguins. Now, there's no defined reason why they call it penguins. In listening to another talk, the speaker had mentioned maybe because penguins look professional and they kind of just stand around, hence they used the term penguin. So these shareholders are also shareholders of the REIT, and they earn, I think the minimum investment they'll put in is $1,000. So it's a small investment in the REIT, and they earn a certain yield for having their investment in the REIT, called shareholders. So again, just to cover again, you have your investors. Those investors are going to invest in the fund. Okay, so they become owners of that fund, and then that fund becomes a shareholder of that REIT, and then that REIT's underlying assets are the loans that they're, or the mortgage fund, or the deeds of trust, excuse me, that they are securing against those properties. Now, the flow of capital occurs this way. So those borrowers make their interest payments to the REIT. The REIT then distributes those funds to the mortgage fund. Okay? And then the mortgage fund makes their monthly or quarterly distributions to the investors. Now, again, we talked about 90% of that income has to be paid out from the REIT to the mortgage fund in terms of dividends. And so that's what's happening. The interest income that's generated from the loans held by that REIT are paid as dividends to the mortgage fund. And that's what's important to circumvent or qualify for some of the tax advantages of investing in a fund that's structured as a REIT. So one of the tax advantages of investing in a mortgage fund that has a REIT component is QBIT. Okay, that's also known as Qualified Business Income Tax Deduction. So in the 2017 Tax Cuts and Jobs Act, they passed or created a tax deduction up to 20% of qualified business income for owners of LLCs, S corps, trust, and estates. So what they said, the income generated that flowed down to the owners from these entities, 20% of that income can come as a tax deduction. Now, that's a great tax deduction. The problem is that in order to qualify, you would have to have income less than, if you're a single filer, of $157,500 or $315,000 if you're married. So a lot of high net worth investors that were invested in these entities would not qualify for that 20% tax deduction. However, in the same regulation, it did say that REITs, now this is straight off the IRS website. So if you went to the IRS website, literally it's verbatim off the IRS website. If it is a REIT, the REIT is not subject to that income, the W-2 income qualification. So 20% of the income generated from the REIT, which pays out by dividends into the mortgage fund. If you remember here, the REIT is paid out in dividends to the mortgage fund, doesn't have that restriction. So all investors in the mortgage fund with the REIT structure, now I'll take a caveat on this because this is where it starts to get into the weeds. That income has to be generated at the REIT level. So if that mortgage fund were to invest in trust deeds or in mortgages at this level, even if it had the REIT, that income generated at this level would not qualify for that 20% deduction if you had income greater than the income that we talked about earlier. So it's all the income that's generated at that REIT level. So that is one huge advantage of investing in a mortgage fund that is structured as a REIT. For those that are foreign investors, PTP is considered publicly traded partnerships, and it has to do with withholdings that are required for foreign investors. And we'll go ahead and have a or a webinar specifically based or for foreign investors and how they can invest in the mortgage fund as well. So unrelated business taxable income. This is specific to people that invest with a self-directed IRA or some other type of retirement account. So it's considered, you may have heard the term UBTI, also known as UBIT, UBIT. And what it simply says is that gross income derived from your investment through a self-directed IRA that is unrelated to the initial investment can be taxed at your normal tax rates. Now, for most people that are investing in a investing in trust deeds or in a mortgage fund, this really doesn't apply other than the fact if you use leverage, you will be charged, it'll be considered a taxable event from the leverage that you used. So what am I saying? So let's say that you invest in a mortgage fund. Okay, and that mortgage fund is leveraged at 50% of assets. 50% of the income generated by that mortgage fund, you as a self-directed IRA investor may be subject to your income tax. You'll also be required to file a Form 990T. Now, a lot of mortgage fund operators are not letting their investors or making their investors aware of the potential issue with UBIT. Now, with a REIT, on the other hand, REITs are not subject to these restrictions. So, and I'll jump down right here. So any income generated from the dividends at that REIT level are not going to subject self-directed IRA investors to any type of UBIT regulations. And again, this is going to be important for people that invest in mortgage funds right now. You're going to want to talk to your fund manager. Number one, confirm that that it is a REIT structure that you've invested in. And if not, they should provide you in your K1 the information that you'll need to know of what taxable implications you may have. This is another one that really came to light when I was going through the certification process as fund managers, and this is non-resident tax filings. So if you're invested in a mortgage fund, that mortgage fund is going to do loans, potentially just, we're in California, we focus on loans in California, but a lot of mortgage funds will go outside of their domiciled state to do loans. So in California, you may be doing loans in Arizona, Nevada, Oregon, West Coast, those states. Well, if I'm a mortgage fund, I technically have to be filing tax statements in each one of the states that I'm lending in. That's income generated in each one of these states. Those tax filings then get pushed along to the investors in the fund. So if, for example, you're in the state of Arizona or Nevada where there's no income tax, you have a withholding requirement for any income generated from loans in the state of California. And that becomes, again, problematic for investors that they're not aware of when they invest in a mortgage fund. So again, if you're in low tax states like Arizona, Texas, Nevada, Florida, and Montana, some of the other states, you need to be cognizant of the mortgage fund and the underlying loans or locations of where they are investing in, because you could be subject to the income tax laws of that state. Not with a REIT. Okay, a REIT, though, files taxes in each of those states. That income, you don't have the income withholding requirements that you would have with a normal mortgage fund. Now, again, this gets really complicated, and this is where I would suggest that you speak with your CPA as to what the withholding requirements are for you individually in the state that you're in. And then you can go back to your mortgage fund manager and see what kind of, how it would affect you at the end of the year. But again, those REIT dividends, okay, don't have those same withholding requirements that a typical mortgage fund that does not have a REIT component would have. So foreign investors, and I'm going to kind of jump through this because, again, we don't have too many foreign investors. Typically, if you're a foreign investor, if you're investing funds that are out of the country and you bring them into the United States and invest in real estate here, it will trigger what we called effectively connected income, which could trigger a tax liability and filing obligation here in the United States, which would require which requires a withholding requirement. Through a REIT structure, that interest income is going to be converted into ordinary REIT dividends and may not be factored into ECI for foreign investors. Now, there is a specific structure that is required for foreign investors to invest in the mortgage fund. And if you are a foreign investor and interested in investing in our fund, we can walk you through how that structure would work. So that generally goes over some of the general tax implications and advantages of investing in a mortgage fund that has an underlying REIT structure. Want to go over quickly the offering that we offer with TaliMar Financial. We have a Reg D 506C mortgage fund by the name of TaliMar Income Fund. The offering size is roughly $250 million with a minimum investment of $50,000. Now, right now, the outstanding assets under management in the fund are a little over $22 million. And that invests in roughly 40 loans as of today. Now, originally we structured the fund to have a preferred return and profit split. However, with the recent increase in rates, we've gone ahead and eliminated that structure and essentially have created a structure in which investors will earn the weighted average coupon of the mortgage fund less a 1% servicing fee. So last month we had an investor return annualized yield of 8%. I crossed out 7.25 because when we originally structured the mortgage fund, our initial or kind of bogey for investor returns was around 7.25. However, we've been able to replace and fund loans that have a higher yield, and we're able to return the investor on an annualized basis last month of 8%. And we should be shooting over that here, closing out Q4 of 2022. Distributions of the fund are done monthly. Right now, we do not charge any management fee. Income is generated from the loan servicing fee of 1%. We allow investors to reinvest their distributions. And yes, we use leverage. And that's going to be a whole nother webinar on why we use leverage in a mortgage fund. But effectively, it's imperative that a mortgage fund uses leverage. I get a lot of questions from investors. Well, Brock, why do you use leverage? And really, it's a cash management tool. So if you're investing in trust deeds right now, one of the hurdles that you have is as trust deeds pay off, that cash sits in your account, not earning any income until you reinvest that in a new loan or new trust deed. Same with a mortgage fund. So as a loan pays off, those funds sit in our operating account, not earning any income. Well, one way you can reduce the exposure or issue with what we call dead money is use of leverage. And so if I know I'm going to have a couple payoffs in the future, but I have a loan that I can fund right now, I can tap our credit line, close on that loan, and then when those payoffs occur, pay down the balance of that credit line. So that reduces any cash drag that we have on the fund. The lockup. We do not have any lockup period in the fund. We did have a 12-month lockup period, but we're a relatively liquid fund, and so we've eliminated that lockup period. A redemption period. So once you've requested a withdrawal, that's a 90-day written notice, and we have up to 90 days to distribute those funds back to you. And the fund manager is TaliMar Financial. So TaliMar Financial, originate those loans. We place them in the fund, and then we use a third-party servicing company to service our loans and use a third-party fund administrator to do the actual day-to-day accounting of the fund. So some of the lending guidelines that we have of our mortgage fund is we primarily focus on first trust deeds in the Southern California and General California markets. And I do write second position loans, though most likely we would not have second position loans unless there becomes a situation in which it requires us to do a second position loan, maybe in an effort to, we have an issue on a first that it makes sense to record a second. Loan to value ratio, we try to keep it 70% or below of current or after repair value. And loan terms, we have the option of 12 to 60 month loan terms. Now, we're really focused on doing short-term loans at this point, simply because of the rising interest rate environment. We don't want any long exposure should rates jump up dramatically higher. So we keep those as short-term loans. The types of loans that we're focused on right now are going to be our fix and flip and fix and hold loans, though they do make up a smaller percentage of the loans we're originating. We're seeing a lot more bridge loans. Fix and flip loans obviously are for loans in which the end borrower is purchasing a property to renovate it and then sell it for a profit in the future or rent it out. All right, so back to what I was saying was Verivest is, if you're currently invested with our fund now, they're the fund administration company, and they're responsible for doing the day-to-day accounting of the fund. Also, they provide the monthly statements and then the year-end statements as well. They act as a kind of a third-party reviewer of the fund accounting per se. Now, they're not a auditor, but they do provide a lot of investors a comfort that there's a third party kind of reviewing the fund accounting. Loan servicer, a lot of you who invest in trust deeds are familiar with FCI Lender Services. They're one of the nation's largest servicing companies that assist the private lending industry. We've been working with them for, over 10 years now. And so they're the ones that collect the monthly payments from the borrowers. They're the ones that distribute those proceeds to our trust deed investors and the fund. And they're the ones that handle all the monthly and year-end statements for both the borrowers and the investors. Jurassic LP is our legal. They're one of the largest firms that specialize in doing creating mortgage funds and then managing mortgage funds as well. Our bank and financial is Endeavor Bank. And then BitCaught handles all the technology. So all that back office, if you've gone to our lender portal, they're the ones that have designed and continue to maintain that lender portal. So our fund overview, as I mentioned, we have about 40 assets in the fund, a little over 23 million in assets managed by the fund. Our average loan size in the fund is roughly 560,000, with an average yield in the fund of 8.2%. And 8.2 represents the weighted average coupon for the fund. However, that's before expenses. Average loan to value is roughly 64%, just over 64%. Our bogey again is 70%, but I like to try to keep that at 65% loan to value. The average term of the loan is 16 months. So as I mentioned, we try to keep that average term down as close to 12 months as possible, but keep it below 18 months. So loan type, as I mentioned, the majority of our loans are bridge loans. These are just loans based upon current value. These are short-term loans, either to do a quick purchase for a borrower or to refinance an existing loan with the intention of either the borrower is going to sell that property or refinance us out within a 12-month period. Now, roughly another 40% are going to be fix and flip and fix and hold loans. This has really kind of been our bread and butter for the last 14 years, working with investors to provide them capital to buy properties that are in disrepair, provide them the funds to renovate those properties and sell them. I think we've done over 600 transactions here just in the Southern California, in the San Diego market alone, of those types of transactions. I like them because, number one, they're secured on single family and small multifamily properties. The exit is clear. Either they're going to sell the property or they're going to refinance it. Third, they're updating the property, so they're adding value to the property. Some of the reasons why I really like that market segment. Now, we've got one construction loan on our books. As I mentioned, I don't think we funded one over over the last 12 months. This one, the construction is completed and then the process of selling the property. So again, our focus right now is heavy on SFR. I like that SFR product simply because, number one, it's the most heavily transacted product type. Financing is the easiest when you refinance or sell or buy a single family house. And in many of the markets that we lend in, so your San Diego's, your Los Angeles, Orange County, San Francisco's, there's just a lack of supply of housing. So they're going to be less impacted from any market adjustments than potentially other product or property types. So the rest is commercial and then also industrial as well. As I mentioned, majority of the fund are secured on assets here in the San Diego market. As I had mentioned earlier, I like the San Diego market. Again, the supply of housing far exceeds the amount of demand there is for housing. So I think that we're well buffered from any huge market swings. And the rest are in various other markets throughout California. Now, one of the advantages of working with TaliMar Financial we offer is a lender portal that we have designed ourselves. And the lender portal allows investors to log in and not only view and invest in the trust deeds we offer, but to view the mortgage fund. I'm going to take a moment to go ahead and log in and share my screen. And what you should see is the lender portal. And I can give you a link to the lender portal to log in. But on the dashboard, you'll see all your accounts with TaliMar Financial. These are all the accounts that I currently have with the company. You can view your trust deed portfolio. So view all the trust deeds that you have in your portfolio. You can view all the available trust deeds that we currently have. So we do offer two platforms. So for investors that want to invest in individual trust deeds, you can always log in and view the available trust deeds that we offer. Or you can log into the mortgage fund. And the value of the mortgage fund is that it's a much more passive investment. You're not having to log in and view all the trust deeds that we have available, to select those trust deeds, and then to manage those trust deeds. If you're interested in learning kind of more about what the difference is between the trust deed platform and the mortgage fund platform, take a look at that video that I created last week. I'll send a link out and you can see kind of the pros and cons of investing in both. But under the mortgage fund, you can go to the drop-down menu and you can actually view up-to-date information on the mortgage fund. So you can look at all the assets in the fund, current balances, average loan sizes, loan types, property types, and whatnot. So this is all real time. This is all the information that you see is what I see in real time. So as we add loans and loans pay off, all of this information gets updated. You can also take a look at the loan schedule. I think this is what's really important for investors, is to understand kind of what are the underlying assets in the mortgage fund. So we list all the loans in the portfolio, including the location of that loan, the property type that is securing that loan, the loan type, the balance, loan to value, the ownership of that loan, the lender rate of that loan, the monthly payment, and then the loan status as well. Now you also have the option to add funds. So if you're currently invested or you want to invest in the mortgage fund, you can select add funds and go ahead and submit your pledge. And you also have access to the executive summary. So if you're thinking about investing in the fund, but you want to review more information, feel free to select executive summary and you'll be pushed to a page where you can submit that request. So just a quick brief overview of TaliMar Financial. We've been 14 years of experience. We've, as I mentioned, have funded well over 800 trust deeds successfully, funding over $325 million. We've had a consistent track record of returning 100% of investor capital and 100% of investor returns. We've developed proprietary software in-house that allows us to manage the large volume of loans that we currently service and that we originate. And so that allows us to be completely transparent with you through the lender portal of all the loans that our mortgage fund is currently invested in. One of the things that that I believe is focus on what you're good at. And we are good at originating loans and selecting loans that are good for our portfolio or for our trusted investors, and outsource those items that you don't have an expertise in. So we outsource the loan servicing to FCI Lender Services. They specialize in collecting payments from borrowers, and they know all the rules and regulations in both counties and states that we lend in. Additionally, we work with a third-party fund administrator, Verivest, to really handle the day-to-day accounting of the fund. And so that allows us to focus on the origination and selection of good loans. Our focus on our mortgage fund is that we invest in core property types in urban markets with strong borrowers. So I'd say that we take a more conservative approach to the loans that we're funding. Again, we want to be in markets that have that supply-demand imbalance, where that demand far exceeds the supply of housing. Again, because I think it'll buffer us from any market disruptions. And then also in urban markets. So again, that feeds into that supply and demand. And then with borrowers that can demonstrate not only the ability to pay, that have a historical track record of making payments, and that have experience investing in real estate. And then one of the mantras we do have is education, accreditation, and verification. So one of the big things that I do is continue to educate myself and my staff on any new regulations, new rules that are occurring in the lending industry, and then get any information or get accredited on this. So for example, we went ahead and got accredited for fund management. And then again, verify that our employees and myself are aware of those new regulations that are being pushed out by the various states. So if you are interested in getting started investing with TaliMar Financial, please contact our investor relations team. If you're interested in investing in the mortgage fund, you can easily request the executive summary by sending an email to myself, and I'll get that executive summary out to you, or going through the lender portal. I can get, if you don't already have access, get access to the lender portal. You can submit your pledge through our website, or just submit a pledge request through me. We'll go ahead and complete the accreditation process. So to invest in our mortgage fund, you will need to be an accredited investor. What that means is having net worth absent of your personal residence of 1 million or greater, or have certain income requirements. So we'll go ahead. That accreditation process just takes a couple of days. And once we're completed there, go ahead and submit the subscription agreement to you for review and signature. And finally, wire your funds to get started in the fund. So feel free to reach out to myself or my investor relations team. We're more happy to get that started for you. So with that, just want to say thank you for listening to our webinar today. As we had discussed, there are some significant tax advantages of investing in a mortgage fund that is structured as a REIT. We covered topics such as QBIT, Qualified Business Income Tax Deduction, in which 20% of that income generated out of the funds earned in the REIT is deductible. We talked about for self-directed IRA investors to be aware of the tax implications if the mortgage fund you're investing in isn't structured as a REIT. So you may want to talk to your CPA and also talk to the fund manager if you're currently invested in it. And then we also talked about for foreign investors, the ability to invest in a fund and not have the withholding requirements for foreign investors. And then fourth, we talked about if you're investing in a mortgage fund in a state that is not domiciled, you're not domiciled in the same state of the fund, some of the tax implications that might occur for you. So with that, I suggest please go ahead and submit any questions you have. I see one question up there right now. And submit any questions that you have. I'd be more happy to answer them for you. So question is, who monitors insurance coverage for properties? Also, are you concerned about properties not having earthquake insurance since the portfolio is primarily in Southern California? Good question. So internally, we have processes that monitor all the insurance. The REIT or the individual investors are named as insured on each one of the policies that are covering the the properties that are securing the loans in the fund. Are we concerned about? Yes, I mean, there obviously there's some concern about earthquake insurance, but it is not a requirement that we have for the mortgage fund. Are the SEC audit requirements for this REIT? There are not audit requirements per se, but it's in best practice that if the fund is greater than 20 million, that there is a audit that is done annually for our fund. There are also some additional SEC requirements for the REIT specifically, but there's no annual or actual requirement. We go ahead and submit documentation confirming that we've met the REIT requirements, but there isn't a physical audit that is done. The audit happens at the fund level, and we'll have one done, being that it's our first full year as a fund done by the end of this year, and it's also a requirement by our bank that provides the credit line. Any other questions? Let me go through a couple of questions that a lot of investors have when investing in the fund. I think some of these things are important to review. When you invest in a mortgage, or the big difference between investing in a mortgage fund and investing in a trust deed is that in a trust deed, you are named the lender for that trust deed. And so technically the borrower is paying you directly as the owner of that deed of trust. There's some positives and negatives to that. And I've kind of oversimplified this scenario. Really what would happen with the borrower would make the payment to the servicing company, which is FCI, and then that payment would be made to you. Unfortunately, the disadvantage to this is that you do open yourself to litigation on any loans that might be going into foreclosure. The advantage of the REIT, of the mortgage fund, is it acts as a buffer for any litigation that might occur due to foreclosure. So you're investing in the fund, and the fund is what is buffering you from any litigation from borrowers that might litigate a foreclosure. Another common question I get is, Brock, what am I investing in when I am investing in the fund? You actually become a member of the LLC, the mortgage fund, and then the fund is what actually funds the deeds of trust. And so the fund is secured on that deed of trust on the property that it's lending against, and that's kind of what your security is. Common question I get also, we talked about with investing subsequent investments. So the minimum investment is $50,000 with every subsequent investment of $1,000 or greater. Now, a lot of questions come up. Okay, well, let's say I invest $50,000, Brock. Can I reinvest make the reinvestment every month, even though it isn't at or greater than that $1,000 minimum requirement? And the answer is yes. Especially for self-directed IRA investors, I'd highly suggest that you do reinvest the proceeds, because the proceeds are probably not going to be big enough for you to invest in some other investment. So if, let's say, you're earning $500 to $1,000 every month with your investment, it's probably better off just reinvest those funds, because now those funds compound the next month. So if you were to invest $100,000 and you earned $700 that month, next month you're going to be earning income on the $100,700. So another question here is, how liquid is the fund? The fund is relatively liquid. So we have loans that are coming in and getting paid off all the time. So in order for you to get your funds out of a mortgage fund, two things technically would have to happen. First, either you have a payoff of a loan. Okay, so the proceeds from the payoff of that loan would go to pay down to cover your withdrawal, or you have a new investor comes in, and that investment dollar that's coming in is essentially a wash, and that gets paid out to you. Now, one thing to keep into consideration, obviously in markets where you have a lot of transactions occurring, you have a lot of payoffs occurring, a lot of investors coming into the fund. One of the disadvantages of a fund is if you don't have a lot of payoffs or you don't have a lot of investor capital coming in, you're going to have to wait a little bit to get your investment out. Okay, with that, I think that does it with any other questions. If anyone has any questions that want to ask me offline, feel free to send me an email. You can find my email bvandenberg@talimarfinancial.com, or feel free to give me a call at 858-242-4900. I'd be more than happy to talk to you more about mortgage funds, the tax implications of the mortgage fund with a REIT, or just answer general questions for you regarding trust deed investments. Hey, thanks for listening to the webinar, and I look forward to seeing you at future webinars. We do have an upcoming webinar with Brian Davis. That's on November 9th, 11:30. Go ahead and send out an email on that as well. And Brian Davis is with AccuPlan. He's going to talk about investing with a self-directed IRA and some of the tax implications and advantages of investing through your self-directed IRA. So if you currently have a self-directed IRA, or you're thinking about opening up a self-directed IRA, he's our expert that we work with a lot on sending or helping investors set up that type of account. So hopefully see you there. I'll go ahead and send the invite as well. Thank you very much for listening, and talk to you soon.